Let's talk a little bit about dividends. Now, we have already told each other that dividends is the distribution of profits from the company to its shareholders. And what type of profits? Well, they have to make a net profit for the year, and then based on the profit for the year, the directors can recommend an amount that they think the company should pay by ways of a dividend. Now, this recommended dividend is then approved by the actual shareholders at the general meeting. So at the end of the day, although the directors just make a recommendation, it is the shareholders who actually decide how much dividends should be paid. Now, here again, there are a couple of dates that is important. Dividend declaration does not necessarily happen on or before the financial year end. Dividend declaration very often only happens at the general meeting of the shareholders, which happens after the financial year end has already closed. But the fact of the matter is that it doesn't matter when the declaration took place. As from the date of the declaration, the directors have a legal obligation to pay a dividend. So now I've said when we actually touched on things like cumulative preference shares, we said that there was a fixed deposit of a preference share, and that fixed deposit that fixed percentage constituted the amount of dividend that shareholder is entitled on. It was either 10%, 12% preference share, and that percent is the indication of how much dividend you should receive. Now that is true. But if the directors did not declare a dividend, nobody is entitled on a dividend. So it is only once they have declared a dividend that the shareholders becomes entitled on a dividend. Now that has a very important accounting implication, because when does the liability exist in our books? From the date of declaration of the dividend. So as soon as a dividend has been declared, we must raise an obligation or commitment or liability in our books, which constitutes the amount that we actually have to pay the shareholder as a dividend. Now, if you think about the conceptual framework, go back to the conceptual framework and go and read what is the definition of an expense. And you will see that one of the disclaimers of an item to be an expense is that it should not be a distribution to the equity holders of the company. So a dividend only goes to the equity holders or the shareholders of a company. Therefore, a dividend is not an expense. And because a dividend is not an expense, we cannot show that in the income statement, because the income statement is statement of profit or loss. And what is a profit or loss? The difference between income and expenses. So dividends is not an expense, therefore dividend paid, dividend declared cannot be shown in the income statement. Now, we have to reduce our retained earnings when we declare a dividend, because a dividend is a distribution of profits. So if we want to reduce our retained earnings, that is something that happens outside the income statement. And we will show that in the statement of changes in equity, where we're going to debit a dividend that needs to be paid against retained earnings. So eventually we're going to debit retained earnings, and we're going to credit a liability account, shareholders, for dividends. Now, a Class A dividend. So a dividend payable on an ordinary share can be a variable amount. That will depend how much profits is available for distribution in the year. And we always quote a dividend as 20 cents per share or 50 cents per share. That's the only thing that I know of in this country, which we still do in cents per something. So the dividend will always be cents per share. Now, each share which has been issued on the declaration date is entitled on this dividend. So talk about ordinary shares. All ordinary shares that's issued on declaration date is entitled on the dividend. Now, we get a dividend declaration date, and from that date we say that the company is now liable for paying a dividend. Who's going to receive the dividend? The shareholders. But what if a shareholder, the dividend is not going to be paid at the declaration date? It probably is only going to be paid 4, 5, 6 weeks after the declaration date. Now, what happens if somebody had a share, let's say on the 1st of March when the dividend declaration took place, but the actual dividend was only being paid the 1st of April? Now, there is a last day of registration. So they're going to say all shareholders that was registered shareholders on the 15th of March will receive the dividend. So if I'm a shareholder, and I was a shareholder up to the 15th of March, and although I'm only going to pay the dividend at the 1st of April, those shareholders who were registered shareholders on the 15th of March is going to receive the dividend. Now you will see if you go and have a look at share prices, that shares are trading so-called cum-div and ex-div. Cum-div means inclusive of a dividend. Ex-div means excluding a dividend. So if I want to sell my shares from the 1st of March, the dividend declaration, up to the 15th of March, I'm going to sell my shares inclusive of a dividend. Cum-div, because in that period of time, the guy can still change his name on the register, on the shareholders register, and because he was a shareholder at the 15th of March, it doesn't matter whether I've been the shareholder for the full year. That guy who is in the register on the 15th of March as a registered shareholder, he's going to get the dividend. So therefore, because I know what the dividend is, and I was actually the person who was entitled on the dividend, if I sell my share between the 1st of March and the 15th of March, my share price will include a portion which constitutes the dividend. So I will make sure that that guy is going to receive the dividend. He's actually paying me the dividend, including in the share price that he's going to pay. Now, from the period 15th of March to the 1st of April, when the actual payout date of the dividends is, that period is going to be ex-div. So that means the share price will exclude the proposed dividend that's going to be paid, because this guy, who is the shareholder on the 15th of March, is in any case going to receive the dividend. Oh, these dogs are driving me crazy. Right, now preference dividend. We said, well, and opposed to an ordinary share, a pref dividend is either a 10% dividend, 15% dividend, whatever. That percent is an indication of how much dividends he is entitled on based on the capital value that he has invested. So it's a fixed dividend. It is also a time-based dividend. The ordinary dividend, time has nothing to do with it. I can be the owner of that share from the 13th of March. Not even the last year I wasn't even the owner. So if I'm in the register as an ordinary shareholder on the 13th of March and the last day of registration is going to be 15 March, I'm going to receive that dividend on the 1st of April. And how much dividend am I going to receive? If I have 100 shares and that dividend is 10 cents per share, then I'm going to receive 100 times 10 cents, I'm going to receive 10 Rand. Okay. Opposed to a preference shareholder, he says, well, I have 100 Rand invested in your company. I'm entitled on 10% dividend. And I have to get 10 Rand worth of dividend, a fixed dividend. If I became a shareholder 6 months through the year, I will only be able to and entitled on half of that 10 Rand. So I'm only entitled then on 5 Rand. So a preference dividend works like interest on a loan. It is based on the number of months of which I owe that dividend to the shareholder. Now, when will I start owing dividends to the shareholder? Once I've issued the shares. So if I've issued new shares halfway through the year, on those shares I'm only going to pay 6 months worth of dividends. If those shares was in issue right through the year, then I have to pay a 12 months fixed dividend on the preference shares. Now certain shares, like you will see compulsory redeemable preference shares. Let's look at the words. Compulsory means you cannot get out of it. Redeemable means I have to pay it back. And preference shares means that there is a fixed percentage. They've got a preferential right on something. Let's assume the preferential right in this case is on dividends. So you have to pay them their dividends first before I can pay any ordinary dividend. So I have to declare a preference dividends first, any type of preference dividend, before I can declare an ordinary dividend. If I have a redeemable pref share, it means that I have to repay the shareholder the amount invested by him at some fixed, or maybe it's not so fixed, future date. So the nature of that transaction is that the dividend applicable to that share is like an interest that he has to pay on the outstanding amount, and that outstanding amount, a capital amount invested in the company, is of a loan nature. So a compulsory redeemable preference shares means I have to repay the share at one or other time to the shareholder. So I have to give him his money back. It works like a loan. Bank grant me a loan, and at some stage I have to repay the loan. Accompanied to a loan is an interest rate. That interest rate has been agreed upon when we actually entered into the contract, the loan, the borrowing or the loan agreement with the bank. So I know I owe the bank 12% interest. And likewise here, when a compulsory redeemable preference share was issued, included is, let's say, a 12% dividend rate. And that dividend replaces or has the same kind of nature as the interest payment that we're going to make to the bank. Now, there are also two further words that you have to become familiar with. So one is the interim dividend and the other one is the final dividend. Now, interim dividend is paid quarterly or halfway through the financial year. So it is not at the end of the financial year. At the end of the financial year, I'm going to declare my final dividend for the year. So interim dividend has been declared during the course of the financial year. A final dividend has been declared at the end of the financial year. Now, a preference shareholder has a right to a dividend before the ordinary shareholder, but the preference shareholder also, just like the ordinary shareholder, is only entitled on that dividend when that dividend has been declared. A company cannot declare a dividend if that is going to have the result that the company is going to be insolvent after the dividend declaration or the payment of the dividend. So that is one of the provisos. Let's say ABC Limited declare an ordinary dividend of 250 cents per share for the year ended 31 December 26 on 28 February 27. There are 100,000 ordinary shares issued. The payment of the dividend took place on 31 March. So here are three dates. The first one is year end was 31 December 26. The second one is on 28 February 27 the dividend was declared, and the third one is this dividend which was declared was only paid on the 31st of March. So what do I do when? What do I do on the 31st of December? Guys, I do not do anything on the 31st of December because no dividend has been declared as yet. We will only pass a dividend once the dividend has been declared. So then the company has a commitment and a liability to pay the dividend. What happens on the 28th of February? Now, the 28th of February is dividend declaration day. And that is the date when the obligation actually originates to the company that he is obliged to pay a dividend. So he's going to debit dividends, 250,000 Rand, and he's going to credit shareholders for dividends, the amount that he owes them, 250,000 Rand. And that equals 250 cents times 100,000 ordinary shares. That gives us then 250,000 Rand. What happens on the 31st of March? Well, on the 31st of March, the actual payment takes place. So then I'm going to debit my liability account, shareholders for dividends, and I'm going to credit bank with 250,000. What happens at the end of the year? At the end of the year, I don't have shareholders for dividends anymore, so that's out of my books. My bank has decreased with 250,000, which is right. I've made a payment of 250,000. But what do I do with this dividends account that's lying there at a debit? Now, it's not an expense account. Why not? Because it is a distribution on the owners. It's definitely not an asset, but what did we do? We've reduced our retained earnings because we have distributed our profits to our shareholder. So therefore, we have to decrease our retained earnings. So at the end of the year, we're going to debit retained earnings and we're going to credit dividends. So at the 31st of December, the end of that financial year, we're going to debit retained earnings or retained profit, and we're going to credit our dividends so that we're going to reduce our dividends, our retained earnings. Now, sometimes a company wants to save his cash resources, but simultaneously he knows that if somebody invests in his company, that person does it either to receive a dividend on an annual basis or for capital growth in his investment, or both. So if he invested, he bought 100 shares at 10 Rand each, at least he wants to know in 10 years' time, he at least wants to sell them at 20 Rand each. So that increase in the share price of 10 Rand, that is capital growth. But in the meantime, for that 10 years that he's going to sit with a share, he wants some kind of return, and that some kind of return equals a dividend. So if you do not declare dividends, it seems to be very negative in the marketplace, because what kind of return does this shareholder now earn? And what does he get for the trouble that he went through in order to invest in this company? Now, the companies have decided if they're short with cash resources, so they want to reserve their cash for one or other thing because they want to use it, let's say, for infrastructure investment or whatever. Then they want to give their shareholders something. But instead of giving them a dividend which is paid in cash, they are going to give them shares. So they will give them more shares in the company so that they can actually feel that they get some kind of reward being an investor of this company. And then in that fashion, what are you going to do? You're going to capitalize some of your profits. So you're going to debit your retained earnings and you're going to credit share capital. So the shareholder should be happy. He receives now more shares in the company, which potentially can grow, and potentially somewhere in the future he's going to make a bigger capital profit on his shareholding. So let's assume that a dividend of 250,000 in the previous example was paid by issuing capitalization shares. Now, the dividend declaration part is exactly the same. So the first, when we're actually going to declare the dividend, we're going to debit dividends 250,000 and we're going to credit share capital with 250,000. Shareholders for dividends 250,000. If we actually decided at a declaration of dividend date that is going to happen by ways of a capitalization issue, then we're not going to credit shareholders for dividends first 250,000 and then debit shareholders for dividends again with 250,000 and credit share capital with 250,000. If we decide that it's going to be a capitalization issue at the date of dividend declaration, then we can take that 250,000 Rand straight to share capital. So at the end of the year, we are going to credit that dividend account and debit retained earnings, and our share capital would have been increased with 250,000 Rand.